Example 16.6 then is very similar to the last example that we did. It's sort of an exam level type question where we've got a company, and if we go down to the requirements at the bottom, we're asked to calculate their taxes, but first of all explaining why they're being treated as residents in the United Kingdom, then the calculation of the profit, and then finishing off with the calculation of the tax liability and saying when it's going to be paid. So it is very, very similar to the last question. I suppose what's different is this part A, where we're being asked a little bit of theory about residency. The layout of the question looks very similar to the one before. So for this business, we've got a profit and loss statement. We've got various notes telling us how the expenses are made up. The notes are probably a little bit more detailed than the last one. And I suppose the biggest difference on this one is note 6. So there's a lot more to do on the capital allowances here than we had on that previous question. So that's going to be more involved. So let's have a look at the question then. So first of all, part A is asking us about residency. So if we go back to what we learned at the beginning of the chapter, a business is resident in the UK if it is incorporated or controlled in the UK. All right, so it can be either of those things. Now, if we go back to the scenario at the beginning where it tells us about the business, it says Ballpoint is a manufacturer of pens and other writing implements in the United Kingdom. It was incorporated overseas, so that's not going to make it a UK resident company because it's not incorporated in the UK, but the directors hold their board meetings in the UK. So it's this point here that's making them UK resident, because what they've got is they've got the control in the UK. So they haven't got that, but they have got the control. Control is deemed to be where you hold the majority or the most important board meetings, and they're all in the UK. So this is a business that is going to be subject to UK taxes. If they weren't overseas, and there really wouldn't be anything else left to do with the question. So moving on to part B then, which is the main chunk of the question, we've now got to work out Ballpoint's tax adjusted profit, starting with the profit before tax of 1675. So it's starting with this profit here, as we did in the last question, and then we're going to go through each of these notes here to decide what's allowable and disallowable. So let's write this up then. So tax adjusted profit. So it's the profit before tax, which is 1675,000, and we're going to add back the disallowable expenses. So any expenses that have been deducted to get that profit that we think we can't claim for tax, we need to add back. So if we start at the top of the P&L, first one we've got here is depreciation. We have no notes, but we should know by now that depreciation is an example of a disallowable expense, because a business will get relief for the assets that they've bought through the capital allowances system. Now, the remainder of the items, we've got notes to look at. So we need to look at those 4 notes. So let's have a look at those expenses. So note number 1 is about the gifts and donations. So first one we've got here is a gift to a customer. It's a pen. It costs £20 each, and it displays the company's name. So that would be an example of an allowable expense. It's less than £50. We've got some advertising, and it's not any of the things that we can't claim for, like food, alcohol and cigarettes, unlike the second one, which is food. Right, so it's got to have all the criteria: advertising less than £50 and not food, alcohol or cigarettes. The third item is employees. That's fine. Remember, anything generally for employees is okay, entertaining, gifts, etc. It does have to be a reasonable amount, but we've got to assume an exam, whatever they're giving us, is reasonable. But the donation does need to be disallowed because it's a national charity, although the next one for the local charity is fine. And the one to the political party is also going to be disallowed. So remember, when we're doing these questions, we do need to list each item. So gifts, and I'll just put next to that pens is okay. Gifts of food, we're going to disallow. Gifts to employees, we allow. We've got a national charity, which we're going to disallow, but we're going to allow the local charity. So you have to list everything that's in the notes, and if it's allowed, you're not going to adjust for it. If you're going to disallow it, you're going to add it back. And then the last one, we've got the political party. So on to note number 2 then. Note number 2 looks at the professional fees. So the general rule with your professional fees is that if it's proved to be for trading purposes, it's okay. Anything to do with assets, we're going to disallow, or anything that's non-trading. So if we go down our list then, accountancy fee will be a normal trading expense, that's fine. But fees connected with issuing share capital, we must disallow. That's not a trading activity, that's raising finance. Legal fees to recover trade debts. So it's where we sold to a customer, and maybe they're not paying up, that would be allowable. And also fees to protect the company's internet domain name would also be classed as trade. So we just have one item there in that note to disallow. So let's write it down. So accountancy is fine. Fees for share issue. So sort of any fees to do with issuing shares or raising loans or debentures, anything like that the company might have to raise finance, we must disallow. Fees for trade debts, that's fine, that's your bad debt collection. And the last one, fees for protecting, we'll just put domain. Remember, you don't have to write this out in full, just make sure it's something loosely connected with the notes so the marker can understand what you've done. Note number 3 then looks at repairs and renewals. So it doesn't give you the detail of all of the repairs of 40,800, but it does give us a breakdown of some of it. So some of it, the 14,800 is replacing the roof of a warehouse. Well, that's okay. Replace, renew. You know, if you're adjusting for costs to repair something that was already there, that's fine. And it just say it was in a bad state of repair. But the other one is for initial fees to repairing an office building that we bought in the previous period. It was not usable, that's the key thing, and this was reflected in a reduced price. So this is a bit like the question that we did in the last example. Anything that's to do with initial repairs that we have to do to get the asset into working order, and we can't use it without it, then that will be disallowed. All right, be a different story if you bought the asset and it didn't look great, but you could still use it, and over time you did the repairs, that would be allowed. But if it says in the question that it wasn't usable without spending the money and you bought it cheap, then we have to disallow it. So, roof, repairs, we're going to allow, and I'm just going to put initial repairs, we're going to disallow. Other expenses then includes 3,700 for entertaining customers, Entertaining, we always disallow unless it's for an employee. So that means the next one will be okay. We can also allow the counselling services for employee. That's fine. But we've got a fine for publishing a misleading advertisement. Any fines we have to disallow, except for speeding fines where we've agreed to pay these on the behalf of our employee. So we've got 2 disallowables there. So initial repairs was the last one we did. So we've got entertaining customers. Employees we're going to allow. And then the fine is the last one, which we're going to disallow for 2,600. So we've dealt with all of those expenses there. Now we do actually have another expense right at the bottom. It's not with this group of items because it's basically your finance costs, but it is an expense because it says interest payable. So while we're on the expenses, let's have a little look at note number 5. Note number 5 says the interest payable is to do with some loan stock that was issued during the year. It's to get a loan to acquire some shares in a small company. So it's a loan to do with an investment, i.e. it's non-trade. So we're not disallowing the loan. What we're doing is we're disallowing the interest on the loan because, yeah, it is a finance cost to the company, but it's not to do with the trading activities. So I want to disallow that amount. Now I'm not going to disallow the full amount. It's only the 10,000. All right, so maybe we shouldn't put that up there just in case you're tempted, I suppose. Let's write here, disallow the non-trade element. Okay, so the total interest is 104, but the bit that we want to disallow is the 10,000, the bit that relates to the acquisition of the shares. Right, this bit here is okay because we use the money to acquire plant and machinery. That's to do with the trade, isn't it? It's the non-trade bit we want to disallow. So non-trade interest. That deals with all our expenses then. So the next thing to do is to deduct the disallowable income. And the disallowable income, well, we're looking at the income in the P&L, and it does actually say here, income from investments. Now, there are no notes there, but the fact it says it's income from investments is telling you that you need to disallow it, that it's not trade income, and generally isn't below gross profit. So both of those need to be disallowed. So we've got dividends, which we don't pay tax on anyway, so they've always got to come out. And then we've got the interest received. So at that point then, we can then add it all together. And we should have a figure of 1,499,870. And the last job that we've got to do is to deduct the capital allowances. So we've got to calculate these capital allowances, which we need to use this note down here, which is note number 6. Okay, so we just got a 12-month set of accounts. We've got a brought down balance of the main pool. So let's set this up, capital allowances. We've got the main pool. I'm going to set up a column for the special rate because I suspect we might have one. And then I'm going to set up a total column. So brought forward in note number 6, 18,000. Right, let's have a look at the additions then. So these are the transactions that have took place. Let's sort out where they're going to go. So car number 1, it says here, has got emissions of 165. So that's telling us it needs to go into the special rate pool, right? Because it's above that 110. We've also got a second car, which it says has got emissions of 103. So that's going to go into your main pool. And then we've got car number 3, which has got very low emissions. So I'm going to write next to that that it gets that allowance, that 100%, because it's environmentally friendly. Now, out of the other assets then, we've got something for thermal insulation. So that will also be special rates. We've got some plant going in the main pool. We've got some equipment coming out of the main pool. And there is a note down here saying this equipment that we sold was originally bought for 11,800. So we always remember we take the lower of cost and proceeds when we do that disposal. We've got a water heating system. So that's another special rate item. And then we've got this first car up here being sold. So we're going to put it in the pool and then we're going to take it out. All right. As far as the annual investment allowance, we're going to give it to anything other than the cars. So let's see what we've got here first of all. Then let's put the cars in. Okay, so let's put our additions in for the cars. So we've got car number 1. Let's write it there, car number 1. That's going to go in your special rate. Car number 2, we're going to put that in the main pool. And car number 3 is basically going to be in and out, isn't it? You're spending 8.5, it's going to go in the main pool, but then it's going to come straight out again because it gets that 100% allowance. And let's not forget to put that allowance into the total column. So yes, you buy a car, but you're going to write it all off in terms of allowances straight away. Now your other additions, you're going to get this annual investment allowance. So let's do the special rate items first of all. So we've got thermal insulation. And we've also got the water heating system. All right, they're our special rate. These 2 here, those 2. And then straight away, we're going to write those off with the annual investment allowance. So remember, you get up to that, that million. So what we got here, 89,290. So there's nothing to go in the special rate pool because you're writing it all off. And we're going to carry the allowance over to the total column. Then we've got the main pool items. So we've got a couple of those. Oh no, we haven't. We've got one item, sorry, to go in the main pool at 176. And that will also get written off with the annual investment allowance. Now, I know in this case, the allowance is less than $1 million, but I've kept them separate so you know that you was allocate against the special rate first. So there's been no impact on the pools at this point. And let's finish off with the disposal. So we've got 2 of those. So we've got the equipment you're selling, remember, taking the lower of cost or proceeds. So although I sell it for 12,700, I'm going to deduct 11,800 from the main pool. And then we've got the first car that we put into the special rate pool, we're now selling for 15. So that's going to come out of here. So we're going to balance our pools off to see what we've got left. So in the general pool then, we've got 17,600. So it's made up of your bought forward. You've got 2 cars, but then you've got the 1 car being written off and then the disposal. And that will get an allowance of 18%, which gives me 3,168 to claim. And a balance in my pool to carry forward of 14,432. For the special rate pool, we had 1 addition and 1 disposal. And yes, it is a single asset that no longer exists, but remember, we can't write balances off on single assets. So that only applies when you've got individuals, when you've got some private use and you've got to get rid of that asset. But we've just got a pool here. So even though the asset has effectively gone, we've got to keep writing it off at 6%. And that gives me £300 worth of allowances and a balance in the pool of 4,700. So in total then, my capital allowances for that period should be 277,258. So this is made up of your annually, your first year allowance for your cheap car, your low emission car, your annual investment allowance for your 2 assets, and then your 2 lots of writing down allowances. So the final part then is to deduct those capital allowances from your profit. That will reduce your profit, and that will give you a tax adjusted trading profit, or trade income some people call it, but the profit you're going to pay tax on will be reduced to 1,222,612, and that is your answer for part B.